going beneath the events, headlines, issues, and trends that may affect our marketplace as we take a closer look.
Research company DataTrek has been taking a closer look at Google search terms and trends as a possible recession indicator. Nick Colas, co-founder of DataTrek, joins me now to discuss the findings. So, Nick, the terms that your research found were, in fact, predictors of recession going back to the Great Recession, correct?
That's right. We look at two search terms that are particularly relevant to analyzing the economic conditions of everyday Americans. The first is the term coupon, and the second is the term unemployment. And that's simply the search that somebody would plug into Google and look for results. And we found that in both cases, they were very predictive of the stress that was building in the U.S. economy ahead of the financial crisis and Great Recession, and did a much better job than standard economic measures like unemployment or the CPI to understand what was going on across kitchen tables and in the real economy in the U.S.
So how many terms in total did you examine? Just those two?
No, over the years, and we've been doing this literally since the Great Recession, we have scoured Google, we basically reached the end of the internet looking for any and all terms. We've searched over the years well over 100 terms that might be relevant and found that these two are the best and most predictive of all the things we've looked at.
And the rationale at work here is unemployment. People are worried about a labor market that maybe they're going to have a hard time finding a job in, right? And then coupon, they may need to tighten their budgets at home.
Exactly. And look, I think we all would agree to the notion that we will Google something long before we'll talk about it with even our spouse or our neighbors or our friends. You might not want to tell anybody, including your partner, that you're worried about losing your job, but you will Google unemployment because you might be interested in, okay, how to apply for unemployment insurance or what support services are available. In terms of coupon, you might not want to tell your neighbor that you're having trouble making ends meet, but you'll be happy to type in coupon into Google to see where the best deals are and what discounts you might get. So that's why it's a predictive indicator. It happens, Googling happens before anything else in the economy. You'll search first and then act second.
Is there a degree of accuracy with all of this that can be measured?
There is, and I would encourage all your listeners to try out this tool. It's simply called Google Trends, and it allows you to track over the last 15 years how many times Google users have searched for a particular word or phrase. And the data goes back in a very robust fashion all the way back to 2004, and it gives you a very nice timeline that you can see on your computer or mobile device that shows you exactly how many times people have searched for a term and compare that across history. So, for example, you can see that the peak for coupon searches occurred in December of 2011 and is currently roughly 25 to 35% lower than that today. And it gives you a nice sense of not only the time series, but the magnitude of change.
I have to ask, why just Google and not other search engines like Internet Explorer, Firefox?
Yeah, no, it's a great question, and we do think about that. The two most direct answers are, first, the tool is available on Google, and then for whatever reason, the other search engines don't give you the same data and its digestible format. But secondly, and more importantly, Google does have the dominant search engine share everywhere around the world outside of China. And so you can not only look for U.S. searches, which is what we're talking about today, but you can look for local language searches all around the world, and that's a useful function as well.
So can you tell me what your research is finding about Google search trends as a current predictor of the U.S. economy?
Yeah, there's good news on this point because, given all the market volatility and worries about being at the end of the business cycle, the Google trend data for our indicators, coupon and unemployment, still show a robust U.S. economy. We have been growing for a long time. There are certainly worries that the cycle is going to end, but by these two measures, we're not seeing any real concern in the U.S. population about the state of the U.S. economy. People are still confident in their purchasing power, so they're not Googling coupon as much, and they're still confident in their job prospects and job security, so unemployment searches haven't ticked up yet. We've got to keep watching this for signs because this is a useful tool, but as it stands right now, these are two very positive indicators about the state of the U.S. economy right now.
And as I understand it, you also looked at television and other media trends. What did that turn up?
Yeah, the genesis of that thought was something that we've observed over the last 30 years of analyzing the stock market and analyzing social trends, and that is when people begin to lose their jobs, they tend to consume more media because they have time. They're searching for their next job, but in the interim, they do turn on the TV more often. They do search for shows. They do look at other ways to spend their time because they're not in the workplace. And so far, searches for things like television and other forms of social and visual medium, those searches aren't trending higher yet either. So that does confirm the notion that the labor market still remains robust because people who would otherwise be engaged in work and currently are not yet searching for entertainment in online media.
So just to clarify, in order to signal a possible recession using those trends in media, you'd have to see a spike up. Is that right?
Exactly. Well, the way this data works, because the data sets are so large, is you see them kind of start to creep up at first and then explode as the actual recession takes place. And we always look for that creeping trend higher. But again, in these two cases, television and online media, we're not seeing those trends yet either.
The creep up are you looking at a year over year, month over month?
Yeah, it happens year over year because there's a lot of seasonality in this data. And if any of your listeners do use the Google Trend data, just be aware that you'll see a lot of seasonality. We're used to seeing economic data that's seasonally adjusted. Google Trends is not, so you have to look at year over year.
All right, so we heard now about the consumer impact. Is there a business impact here? With your research, are businesses well served to maybe redefine their positioning on different things?
They certainly are. The lever there is technology. You've seen capital expenditures slow in the current environment, and we've seen that in the economic data that comes from the government. The strong point continues to be software, and we see that across a lot of our work. So businesses are still interested in improving productivity with technology, but most of this that's coming on the software side, using enhanced tools for customer relationship management, for marketing. And you certainly see it in the ad data that you see on Google, from Google or Facebook or other online ad media, where companies continue to invest even more money in online advertising. So the technology angle is definitely the relevant one, but it's coming more on the software side than companies buying upgraded computers or upgraded data centers. The move to cloud computing has obviated the need for a lot of that.
So can all of what we've discussed here also apply as a global economic indicator?
It's a great question. One of the benefits of analyzing the U.S. economy is you're dealing with one language, one culture, one geographic location. And right now, fortunately, the U.S. economy is doing better than most of the rest of the world, as is our stock market, even though it's had a lot of volatility recently. So we use the U.S. data as a proxy to understand where global growth might go. Because right now the U.S. economy is the most important economy in the world in terms of continuing growth. We'll certainly see some kind of recession in Europe over the next 12 to 18 months. The Chinese economy is slowing. So to our thinking, the U.S. analysis isn't just really a geographically centered analysis, but it's also the single bright spot that could keep the global economy from sliding into a deeper recession. That's why simple searches like coupon and unemployment are important, not just for the U.S. economy, but keeping the global economy growing as well.
Nick, this is certainly interesting, and we could talk here for a longer time than we have, but I'd like to check back from time to time to see any updates in trends, any nuances that may be occurring with regard to the U.S. economy, if that's okay with you.
That'd be great. And, we're coming up into the holiday season before we know it, and the data will certainly shift by then.
Well, if this is any indication, there is no need right now, at least, to be on edge about a U.S. recession, as Nick and I have been discussing. You can go to DataTrek's website and check out their blog. DataTrekResearch.com is the internet address for other interesting articles on the different facets of research that they do. Taking a closer look now with Nick Colas of DataTrek, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.